Hello everyone, welcome to my channel CASHNOMICS. Today we'll discuss the case study of IPO that is on SpaceX. So we are jumping right into what is arguably shaping up to be the absolute greatest wealth creation event of our generation, the SpaceX IPO. But we are taking a highly counterintuitive approach today. Look, everyone and their mother is gearing up to buy on day one, but we are going to unpack the exact contrarian playbook from our source material on why sitting out the initial hype might actually be the smartest move you can possibly make. $2 trillion. Yes, you heard that right. That is the staggering jaw-dropping projected on day one valuation of SpaceX. The excitement out there is absolutely through the roof, and frankly, that hype is totally validated. This is slated to be the most talked about IPO of 2026, and honestly, perhaps one of the biggest in financial history. Before we go further, a small but important note that this video is neither recommendation nor related to my investments. Anywhere, if I have mentioned regarding my investments decision or interest is purely based on assumption how an investor could think of. This will help you to learn about this special case study of IPO. Okay, let's dive into this. The source material we are analyzing today features a really fascinating contrarian twist, and that's captured perfectly in this quote. The analysis is wildly bullish, stating, "I genuinely believe it will become the largest company in the world, but I will not be buying on IPO day." So you have got to wonder, how can someone believe so fully in Elon Musk's ultimate vision, acknowledge it's going to be the biggest company on the planet, and still choose to sit on the sidelines when the opening bell rings? Section 1. The historic SpaceX IPO. The hype versus the timeline. Well, the source text makes it crystal clear. The SpaceX is a phenomenal company with an incredible roadmap spanning EVs, energy, and space. But there is a vital lesson here. Being ahead of the curve fundamentally doesn't mean you need to rush your capital. We start with 2026, that's the IPO euphoria. But the grand vision of SpaceX becoming the world's largest business, the roadmap shows that really plays out around 2055. That's roughly 30 years from now. Everything required to achieve that massive scale demands decades of technological development. So right between the IPO and global dominance is a critical middle phase, a decade of dollar cost averaging. The strategy here is that this grand vision plays out over decades, not days, making a rushed, panic day one purchase entirely unnecessary. Section 2. Why skip day one? Facing the financial reality, let me ask you directly, what does a day one purchase actually accomplish? Besides bragging right at a dinner party, we need a look at the stark contrast between the massive premium of the SpaceX IPO and a legacy tech giant like Google. We are looking at a valuation multiple for SpaceX of 100 times sales for a company generating $80 billion in revenue paid with a $5 billion of annual loss. Compare that to Google, 10 times sales, $400 billion in revenue, and massive 52% profit margins. The expectation is that SpaceX will likely grow into its valuation eventually, but at these day one multiples, it is definitely not a bargain. It really comes down to two choices. First, you have got day one hype investing that is driven by a retail euphoria and carries a super high risk of an initial post IPO correction. You know the classic pattern. It's a spike, a frustrating crash, and then a slow multi-year compound. Alternatively, you have the DCA system, dollar cost averaging. This means prioritizing a system of slowly accumulating over a 10-year time frame, buying monthly and building a position logically. Process and discipline beat piling into a hype stock every single time. Section 3. 5 better places for capital, prioritizing fundamentals over FOMO. 3.7 times. That is a shocking low price to sales ratio, and it perfectly kicks off our rapid fire breakdown with our first alternative company. We are talking about Amazon. The stock has essentially gone sideways for 5 years, up just 58% and actually lagging the S&P 500. Yet They are generating $720 billion in annual sales. They own AWS, the world's largest AI infrastructure, and they are vertically integrating with their own custom Trainium AI chips. Despite this massive B2B dominance in e-commerce, advertising, and logistics, Amazon has been almost completely ignored by the recent market hype cycle. It's a really perfect setup for deploying capital today. Next up, get a load of massive number 63%. That is the huge margin percentage that introduces our second major player, Microsoft. Right now, this stock is actually down 7% in a market where almost everything else has made money, but they are posting 280 billion in annual revenue with double-digit growth. They are valued at just 10 times sales and 22 times forward earnings. Azure is skyrocketing. They have got OpenAI baked right in, and the margins are near 63%. Best of all, they operate a Hotel California B2B software ecosystem. Once a business plugs into Microsoft, they never leave. The broader market is kind of ignoring it right now due to some noise about capital expenditures, which makes it a stellar fundamental play. Now, what's genuinely staggering here is the sheer scale of our third company, $400 billion. Remember, this is more than 20 times what SpaceX currently generates in annual revenue. This is Google. While it's up over the last 5 years, it remains a serious bargain at 10 times sales and 25 times forward earnings. You get 15% year-on-year growth. Like Amazon, they are vertically integrating with their own custom TPU AI chips to reduce their dependence on NVIDIA. Plus, you get the absolute dominance on YouTube and Google search. The fundamental takeaway here, buying the SpaceX IPO essentially means you are paying 10 times Google's valuation for just a tiny fraction of the revenue. Crazy, right? So the crucial point is that we have got to shift our perspective. We need to look past the silicon and focus squarely on the power grids. This is the AI energy bottleneck, the critical shortage of scalable, reliable electrical power required to run all the massive AI data centers. Right now, power generation is arguably more crucial than the software or the chips themselves. And this perfectly introduces our fourth most under the radar company, 3 times. That is the tiny price to sales multiples of our next stock, which is a massive opportunity just hiding in plain sight. Meet Constellation Energy. That's actually down 11% this year, yet bringing in $25 billion in annual revenue. They provide exactly what the AI boom needs: scalable, reliable, clean nuclear energy at scale for data centers. And why is it so cheap? Because it has literally zero social media hype. It's not some exciting consumer brand popping up on your feed, and that creates a massive, highly profitable gap between public perception and fundamental reality. Finally, check out this incredible positive free cash flow swing, $1.1 billion. This brings us to our fifth and final stock, Snowflake. Over the last 5 years, Snowflake's stock price has essentially done nothing. But beneath the surface, the fundamentals have absolutely exploded. This is an AI picks and shovels infrastructure play. Revenue skyrocketed from $600 million to $4.7 billion. And that free cash flow swung from $80 million to a positive $1.1 billion with 30% annual revenue growth at 17 times sales. It's a super compelling buy for core infrastructure. It entirely lacks the exciting get rich quick narrative, and honestly, that is exactly the point. Section 4. The hype-free framework. Navigating a euphoric market. We are in a period of significant froth where everything just feels euphoric. So, how do we stay disciplined? First, no trading. We are holding quality companies for the long term. Second, use consistent dollar cost averaging to optimize your cost basis over time. Third, focus intensely on misunderstood businesses where the lack of hype creates real value. And finally, avoid IPO day euphoria. To summarize the core strategy from our discussion today, SpaceX is an incredible company and will eventually join this portfolio through slow methodological accumulation over the next decade. But today, right now, the smart capital goes to these fundamental, strong, overlooked names. I want to leave you with this really provocative question drawn directly from our source analysis. Will you sprint in a 30-year marathon, building generational wealth and investing in multi-decade visions? Requires patience, a strong system, and zero rushing. So, look at your own investment discipline. Are you letting FOMO dictate your pace, or are you mastering your own long term process? Think about that, keep relying on fundamentals, and stay curious. Catch you next time.